This morning we take a look at Petronas Dagangan, UOB-KN maintaining its sell call with a lower target price of 16.75. Last traded at 21.06, so that's about a 20% downside. PetDag has particularly significant earnings risk, though this is not adequately reflected in its share price, which has dropped by only 9% versus KLCI's correction of 16% year-to-date. Of its many products that will be impacted by COVID-19, the riskiest is jet fuel, which accounts for 19% of total sales volume. Its local market share for aviation fuel is about 70%, so with fewer planes taking to the skies, the drop in demand is going to be severe. Meanwhile, retail fuel, about 43% of total sales volume, has also been affected by the MCO since more are staying home. Shorter opening hours and visitor footfall at its petrol stations mean ancillary and non-fuel income from Mesra stores will also take a hit. Furthermore, fewer restaurants and stalls are open, which hurts demand for bulk and commercial LPG. Overall, commercial volume is seen shrinking by 20% this year and retail volume 10%, but not all is bad. As a subsidiary of the Petronas Group, PetDag is able to manage its cash flow better than its peers. Assuming it's able to protect its cash flow to a certain extent, it should be able to retain FY19's dividend per share of 85 cents. So, what's the consensus? We've got 3 buys, 7 holds, and 2 sells. The average target price of 21.25 is close to the current price of 21.06.